Next up, interest costs that are incurred or related to the construction of a factory, a building, equipment. First, do we capitalize these? What is capitalization? We talked about this earlier. What costs are included in a building? What costs are included in land? Capitalizing costs means we add them as an asset. Assets have an anticipated future benefit. So this differs from taking a cost and expensing it today. With capitalization, we take those costs, record them as assets, and then over time, depreciate them or allocate a portion of that cost that relates to the revenue it helped generate in that period. So if we're talking about interest costs, these are often part of the cost of constructing a building. So we're going to capitalize them. We just talked about why. How about when? Well, the interest costs that are capitalized that relate to construction are those that are incurred during the period of construction. If we think about why this makes sense, it's because when we're constructing a building, we're not using this thing to generate revenues. Those costs aren't helping us do that right now. So we're going to capitalize these costs during this period. But when the building is finished construction, that's where the cutoff ends in terms of capitalizing interest costs. How much in interest costs do we capitalize? Well, interest relates to money that we borrow, and in this case, we're borrowing money to build a factory. So it is tied to the expenditures that we make. And we're going to look at in a second, we want to look at these expenditures in a prorated or weighted way, because some of these expenditures might have happened at the beginning of the year or the end of the year. And depending on the construction period, that's going to impact the interest costs that we capitalize. A good rule of thumb to think about this: how much interest costs do we capitalize? It's the amount of interest that would have been avoidable if we hadn't engaged in this construction process. And doesn't that make sense? We can think about, all right, we have all these interest costs, but what portion of that wouldn't we have incurred this interest cost if we didn't decide to do that? That's the amount of interest cost that we need to add to our depreciable base or capitalize. Let's take a look at an example. This one says comprehensive illustration in the handout. On November 1st, year 5, Shalla Company contracted Pfeiffer Construction Company to construct a building for $1.4 million and land costing $100,000. And it gives us the payments that were made during year 6. So these are the payments that were made while constructing this building. On January 1st, $210,000, March was $300,000, May $540,000, and then at the end of the year, the 4th installment of $450,000. These add up to the $1.5 million total construction costs. It also tells us that it completed the building and it was ready for its use on December 31st, year 6. And then it gives us the debt that was outstanding at that snapshot at that particular date, December 31st, year 6. It asks us to compute the amount of interest that should be capitalized. So let's do this. When we think about interest costs, they are tied to the period of time that you have had use of money that you've borrowed, right? So if it's the whole year, your interest costs are going to be higher than if you only used the money or borrowed it for 2 months. So we're going to use this idea and start by considering these expenditures that we had, and we're going to weight them according to the period of this fiscal year that we're examining. Our end goal, we're going to use this to calculate the amount of interest to capitalize. I'm going to title this column Capitalization Period. The period of the year that we used this money to construct this building or to finance the construction of the building. This is 12 out of 12 months, right? Here we paid $300,000 in March. So this was 10 out of 12 months for the year. This payment occurred in May. That is 8 out of 12 months. And this payment was at the end of the year. That's 0 months. Any interest that relates to here will be next year, right? So we have the capitalization period. Over here, our next column, I'll title Weighted Average Expenditures. It's just our expenditures weighted by their portion of the year. So 12 out of 12 months here is 210,000. We used 300,000 in March. That's 10 months out of the year. So on a weighted basis, that's $250,000. For the May expenditure, this comes to $360,000. And for December, it's 0. So this number, this $820,000, is our weighted average accumulated expenditures. So if our weighted average accumulated expenditures amount to $820,000, a good way to think about that is this is the amount of money that we borrowed to construct this factory, okay? Weighted according to the period of time that we used this money in construction. Let's keep working toward calculating the amount of interest that we're going to capitalize. In the handout, moving down, it details the outstanding debt at the end of year 6, the year that we're concentrating on. The first note or debt that it gives us is a specific debt or loan that the company took out to finance the construction of this building. It was exclusively taken out for that purpose. It's a 15% loan, 3-year note to finance this purchase of the land and the construction of the building. It has interest payable at the end of each year. It was for $750,000. So we took out a specific loan that related to the construction, but look at this. When we think about the weighted average expenditures that relate to the construction, this exceeds the specific loan. So that's where we consider the other loans that the corporation had outstanding at the end of the year. The first one is a 10% 5-year note. This was at the end of year 2 when this was taken out, and it was for $550,000. And then a third loan that was taken out at the end of year 1, it's a 12% 10-year loan for $600,000. All right, so let's take this one first. We think about this amount of money and the interest related to it, we know it's specifically related to the construction. And if that's the case, that interest cost should be added to the building cost or capitalized. So 15% of $750,000, I'll go over here, and this is avoidable interest. This comes to $112,500. Now let's think about this. We accounted for $750,000 of the 820. So essentially we have $70,000 more that was financed through this other debt, right? And we have this outstanding. And how much interest cost out of this do we associate or capitalize related to this building? And here's where we consider our weighted interest for these other loans. So if I'm thinking about 10% for $550,000, the interest on an annual basis related to that loan is going to be $55,000, right? The annual interest related to this $600,000 loan at 12% is going to be $72,000. This comes to $127,000 of interest every year related to these two loans. These two loans together come to $1,150,000. So here we've got our interest related to these two loans, the total principal for these two loans, and what we're going to do is get a weighted average interest rate that we'll use to apply to that $70,000 to say, all right, here's the interest related to this, and here's the interest related to that $70,000. That total is the amount of interest that we would capitalize or the amount of interest that we would have avoided had we not built this building. Let's get the weighted average interest rate for these other loans. I'm going to do this right here. For 127 of interest for both of those loans over the principal of $1,150,000 is a weighted interest rate of 11.04%. So we will take this 11.04%, apply it to the $70,000. That is the difference between our weighted average accumulated expenditures and the specific construction loan of $750,000. So $70,000 at 11.04% is $7,728 of interest associated with this construction. So in total, we have interest related to the specific loan of $112,000, interest related to other debt, but we are saying that $70,000 of that other debt relates to the construction of the building, and that interest amounts to $77.28 for total avoidable or interest that we will wind up capitalizing of $120,228. Here's our calculated avoidable interest. I'll go over here and I just want to reiterate our interest costs to help illuminate the portion that we are capitalizing and the portion we are expensing. Remember, we have 3 loans for this company. The first was a specific loan taken out for the construction of this building. It was at 15%, $750,000. So the interest costs associated with that loan for the year are $112,000. We had 2 other loans. They were existing that we had taken out before, but nonetheless, they helped us finance this construction, right? If we didn't take out these loans, we theoretically wouldn't have had the cash to put towards this construction. Therefore, we want to take a piece of the interest cost from those loans and assign it to this building. The first one was $550,000. Our total interest cost related to that loan for the year is going to be $55,000. The other loan, which was $600,000 at 12% interest, the interest cost associated with that loan is going to be $72,000. So we've got a total interest for the year of $239,000. Remember, we determined that we're going to capitalize $128,228. And what this means is the remaining interest costs we're going to expense right now. That comes to $119,272. All right, let's do some journal entries to finish this thing, or whatever. All right, so remember, we had our first transaction on January 1st. I'm going to take care of that journal entry and then we'll work our way through the year. This was January 1st. We purchased land for $100,000. Remember, 100 out of the 1.5 was for land. So this will hit the balance sheet for $100,000. And the building portion of this January 1st cash expenditure was $110,000. And as we saw at the beginning of this exercise, we paid cash at $210,000 on January 1st. March 1st, we had a payment of $300,000. This was for costs associated with the building. Could have been labor, a lot of different things. Nonetheless, we're capitalizing it as part of the building. Our next one was May 1st. We had a payment of $540,000. And we add to our building account on the balance sheet for $540,000. And then December 31st, we had a payment of $450,000 incurred to build this building. But in addition, we would also pay our interest costs at the end of the year. And here's where we either capitalize some or expense it. So this journal entry, I'll move over here. This is December 31st. And the journal entries that relate to interest, we would have a debit to building for the interest amount that we capitalized. That was $120,228. We would have interest expense that would impact the income statement of $119,000. And then we would wind up paying out $239,500 in interest.